Then I talk about the monetary policy, that is to do with the bank. And in the bank, the Reserve Bank of India has to play a very major role both in situations of the excess demand and the deficit demand. The bank rate when the demand is more should increase, and when the demand is less it should decrease. The formula, the theory, the concept behind it is the same. When it has increased the bank rate, people will have less and they will have less demand. When it is decreasing, people have more money, so it will increase. Open market operations, that is to say selling bonds, securities and so on. They should be able to sell it more, the securities and bonds, that is the savings which we have, more if the demand is more. This will happen because if this happens, then there will be less money in people's pocket, and if the open market operations will have to buy when the demand is less. Okay. But there are also qualitative measures. Qualitative measures to say moral suasion, in which the government has to restrict its credit when the demand is more and expand its credit when the demand is less. Give them less money in the market. Give them more money in the market as the situation demands. That is to say that the Reserve Bank of India issues oral and sometimes written orders to the banks in order to bring about equilibrium in the market. And looking at the excess demand or the deficit demand, the policies have to be enacted by the government in a very wise manner, meaning to say the fiscal policies, the monetary policy and the qualitative measures, all to hit the requirement as it is in the market. Remember, more the demand, we'll have to curb it and see to it that the money is less in the market, people have less money, and thus the demand will automatically come down. If the demand is less, put in more money, that let there be pumping of more money in the market to bring about that increased demand which is required, so that the deficit demand does not lead to deflationary gap.